Good evening, ladies and gentlemen. Tonight on our show we have very special guests with us to discuss the movie Too Big to Fail, which documents the 2008 financial crisis and the impact on the U.S. economy. The topic was sent in by my close friend Dr. Donald Atwater, a senior economist at Pepperdine University. In the house we have Hank Paulson, the former Treasury Secretary, Michelle Davis, who handled PR during his administration.
Happy to be here, Dave.
My goodness, has anyone told you you look like Tina Fey?
Yes, I get that a lot.
And the second most powerful man in the world, Ben Bernanke, the current chairman of the Federal Reserve.
Great to be here. And no, I'm not the second most powerful man.
My first question is for Hank Paulson. After allowing Lehman Brothers to fall into bankruptcy, what was your plan with AIG Insurance and why was it different?
The biggest difference with AIG is they had collateral where Lehman Brothers didn't. We did not lend to the Lehman Brothers because they held failing assets. AIG is a totally different story. For example, the plane I flew in on this morning is leased from AIG. The construction down the street on Fifth Avenue is insured by AIG. AIG insures 81 million policies totaling $1.9 trillion. They control billions of dollars in teacher pensions. AIG was everywhere. AIG was too big to allow it to fail.
I do not understand how that made a difference. How did you go about explaining the complexities of the market situation to the public?
Jim Wilkinson, Hank's chief of staff, authored a statement that simplified the actual events that led up to the potential market collapse.
I remember something about mortgage-backed securities.
Yes. Wall Street started bundling home loans together. These were called mortgage-backed securities. They sold slices of those bundles to investors who were making huge amounts of money. So the investors started pushing the lenders for more loans.
The lenders were already giving loans to borrowers with good credit. Lenders began lowering their criteria for borrowers to qualify for a loan. At one time, you needed a credit score of 620 and 20% down. Now banks took loans from borrowers with credit scores of 500 and zero money down. It became one major moral hazard, to say the least.
So the average Joe on the street thinks the experts know what they are doing, so he reaches for the American dream. He buys a home, saying to himself, if the bank is willing to loan me money, I must be able to afford it. While all along the banks knew that investments made on crap bank mortgages were risky.
So in order to control their downside, the banks started buying insurance against mortgage defaults. If a mortgage fails, the insurance pays. Hence the term mortgage default swaps. This allowed banks to insure their potential losses to move the risk off their books so they could invest more and make more money. The problem for AIG was they were the one insurance company that took on almost all of this type of insurance.
The moral hazard of it all was that the banks took these risks knowing that their investments were insured. Everyone figured, why not? So what if the crap hits the fan and mortgages tank? The bank's investments are insured.
Why did AIG take on so much risk?
It is simple, Dave. Fees. Millions and millions of dollars in fees. AIG based this strategy on a housing market continuing to grow. They figured the party would never end.
Then the unexpected happened. Housing went down and mortgages began to default. The average Joe's teaser rate ran out and he could not afford to make his house payments. Mortgage-backed securities go bad and AIG has to pay all of the mortgage swaps. All of them. All over the world. All at the same time.
AIG can't make the insurance payments and runs out of money. If AIG went under, every bank that insured their mortgages would have posted huge losses on the same day, and then they go under.
And the house of cards comes tumbling down.
Yes. The entire financial system would collapse and would send the U.S. and global economies into a depression that surpasses the Great Depression in the 1920s. I should know. I studied the Depression throughout my entire academic career.
Why did the government let this happen? Why wasn't it regulated?
Nobody wanted to. Everyone was making too much money. As Henry Paulson once said, Wall Street has a gambling problem, and if the government keeps bailing them out, they're never going to learn their lesson.
After a point it felt as nothing would work. There wasn't a bank in the world that had enough money in its vault to pay its depositors. Everyone was an inch away from disaster. On top of all of that, the average Joe and Jane had bad expectations.
Fascinating. We have to jump to a quick commercial break. We will be right back and I will ask you what you mean about expectations.